Okay, thanks everybody for joining us on another Genius Wednesday. Today we're coming to you in an incredibly interesting market, especially in crypto. Bitcoin and everything else is basically going high off the charts, and it's pumping tremendously. There's a lot of interesting things that are going on, and I'd love to open up the conversation to the greater group. Obviously, I'm going to pass it over first to Steve Quan, our head of market research here at Coin Genius, to give his take, and then we'll get into specific topics around some of the things that we think are driving the market. So with that, Steve, pass it over to you.
Okay, here I made one table instead of going into 50 different examples, but the point should be fairly obvious. Now, I'm not making a price prediction in Bitcoin. I can just, it's $8,800 now. Whether it goes up or down from here, I don't know. I couldn't tell you. But I'm going to give you just the basics. I'm just giving facts of what is, what we know, and what could be. So we know the price is 8,800 now. We know there's 18,352,287 Bitcoins that have been mined. And we know that there, according to CoinMarketCap, are 5,403 projects listed there. I know some don't have values, but just keep these numbers in mind because these are just data points. There's no opinions. That means the total market cap is 284 billion. Bitcoin is 161 billion. Everything else is 87 billion. At the end of all the mining, if all that happened was the price stayed stagnant at $8,800, it was just frozen in time, and all 21 million coins were minted, you would have $284 billion total market cap. 185 billion for Bitcoin, everything else would be 99 billion. So these are just extrapolations of if Bitcoin stayed the same, all the coins are mine. Now, I'm going to give you an example of, well, the title of this is how the current market system destroys blockchain projects. I know, odd for someone in blockchain to say that, but anyways, so I'm just going to give you one hypothetical, and I guess what most of the blockchain projects are based on. Believe it or not, the developers and the core teams have significantly less control over their projects than they think. Actually, they have about 30% control depending on volume and price. The lower volume, lower priced assets have about 1% control of their future, where about 99% for Ethereum's the strongest, where it's only controlled by Bitcoin about 62%, while other projects that are in the 1 to 100 Satoshi areas with $1 million of volume or less, those projects, the core teams and the developers, they have about 1% say in what their project does. It's pretty much at the discretion of what Bitcoin price does. I know it sounds weird, right? How can the head of a project have pretty much no power over their own project? Well, it's simple. It's the current market system. And this will lead into a topic later, which Mr. Bourne can extrapolate on. But with Bitcoin's primary trading pairs being something called USD or USDT or BUSD or whatever have you, some coin or token that we, the people who look at markets, deem as $1. Why do we deem it as $1? Because somebody told me to. It's stable, right? And it's a dollar. Somebody said it on the internet. Those are common answers that I see of why USD or USDT or this. But when you look on the websites, it's simply the belief. It's the same as the US dollar system in the US. Why do I believe a dollar is worth $1? Because it is worth $1. But what does that dollar buy? it's the US dollar is in reality is no longer backed by anything. It's backed by the full faith and credit of the US government. So we have faith and credit, hence we use them. But in the Bitcoin system and in Satoshi's vision, I'm not exactly sure if this was what his vision was. Maybe someone who has a little more background could extrapolate on this, but I don't know if he thought the peg for his dream was supposed to be a proxy for the US dollar and something that, if I'm not mistaken, he was trying to get away from that system. Now, stable coins essentially are infinite because we could continue to come out with them and come out. Why do we call them stable? Well, because somebody told me to. When they may be back, they may not be, but in any event. So, because Bitcoin has gone up so much since its inception, 0 to 8,800, obviously a more than impressive record. Let's just say hypothetically that the proverbial shit hit the fan. Sorry for my language, but Bitcoin was $880, so it was divided by 10. Well, divide a billion by 10 and you get, sorry, that's 1.85 billion. And you get, basically, if Bitcoin goes down, it doesn't leave a lot of incentive for other people to join in the blockchain movement, or I guess idea generation, because with the system that we're currently in, Bitcoin being the primary pair for everything else, quote unquote, I don't like to say everything, but I'll say the 99.99%, it can't have a market dominance of less than 50%, because in economic theory, and I'm not a philosopher, I'm not a teacher, but I do understand some basic principles. Anything over 50%, I could call straight up a scam. Why? Because people that wanted to redeem their asset for Bitcoin, obviously we know when people sell, the price would go down. But hypothetically, if Bitcoin dominance is less than 50%, someone will be left holding the empty bag. And that would not be good. So there needs to be, and like today, many people look at Coinbase, oh, Bitcoin's up 10%. Bitcoin's up 10%, but everything else is up 98765. So again, on the downside, people lose value to Bitcoin because it's fixed. But Bitcoin doesn't lose value because people need it to get into what they want to. Hence, I'll say this unequivocally, if this peg isn't broken, then all of us talking about blockchain and all that, it's done. It's a waste of time. And that's my statement, and I would pass the mic back to Jeremy.
Okay. This is all really great stuff, Steve. It's all about looking at the numbers and seeing if you can, look to empirical evidence that can help us to understand and ascertain where things can go. I'd like to pass this over actually to Oz as it relates to some of the data and some of the things that we're seeing as it relates to Steve's comments here. What do you think is happening right now? Obviously, we see this tremendous pump. We obviously know there's a lot of hot air and things that are inflating the traditional equity markets. What do you see happening, and what do you think is the main driver for all this, positivity and upward momentum? Oz, you there? Looks like you might be on mute.
Yeah, I'm just sitting here talking on mute. Awesome. So as Kyle Ray had pointed out last week, before the pump started, there was an upward trend, which was indicative of where Bitcoin was going. And so it went quickly from, 7 into the 8s. I'm just pulling up pricing right now. We are currently at 86.96, and it's up 947%, right? I think week over week. You look at ETH, we're up 16%, XRP's about the same. Bitcoin Cash up 14%. And what we're looking at is I think you need to do the kind of a balancing act here. One is, what are the trading pairs that people actually have access to on what exchanges, and what's the correlation of that data? And that's something I think our CTO is working on in terms of building those things. But two, how are you getting your market metrics and deriving your market analysis, and what's your strategy, I think, for both investments and then also trading inside of this arena. One of the big things coming up is the halvening. A lot of people are speculating one way or the other in terms of what the market's going to do, how things are going to go, but the natural is that we're going to see a doubling. And then we're going to see the reduction of price by about 50%, and then sequential increases based upon differential market factors. I think it's going to be more interesting to also watch what is the drag in terms of those pairs that were negatively affected by Bitcoin, and also what's the uptick in those pairs that were positively affected by Bitcoin. Now, some of those are projects that we've talked about previously that are correlated or built off of either the older Bitcoin core code, or have upgraded to 0.17 or a little later. And at the same point in time, I think what we have to look at is, where is the market starting to go? Because the traditional capital markets took massive hits over the course of the past 60 days. A lot of people that I've talked to who are financial planners on the Upper East Side are telling me that they were able to mitigate some of the losses and the risk, but outside of diversifying funds, a lot of people who weren't really paying too much attention, or had someone who wasn't acclimated to extreme volatility, lost anywhere between 25 to 40% of their portfolios, and that's affecting a lot of people in America. In tandem with this, you've had the president and Congress. I forget if it's an executive order, if it was just a policy change, but you can pull out your 401ks now without any penalties, and I think a lot of this is folks not necessarily knowing that if the traditional fund that they've put their money in, where it's sat there for years and generated them some standard 7% interest, is really going to continue to hold. And then on the flip side of this, we've seen the decoupling and decorrelation of the commodities market from the stock market and the crypto markets altogether. And a lot of that's due to volatility that's really coming from impacts to supply chain that no one's talking about. Why did oil collapse? Because there's nowhere to store it, and you have to stop pumping. The moment that you stop that, you start shutting down massive segments of industry. All the roughnecks in Texas, there's nowhere to put that oil. There's no reason for them to pump. That stuff starts going on hold. The negative oil prices that were out there and the negative futures that all collapsed at the same time, because they were all kind of called in. These have continuing and cascading market effects. There's a stabilization move that's going on, but Venezuela, and I tweeted about this yesterday. Venezuela just went and got some guy who was some sort of trafficking ringleader to lead their oil cartel. So things are very strange in terms of the relations inside of the commodities markets with the major players, including Venezuela and OPEC. And Venezuela is a member, I would say, ish, because they tend to do some of their own policy decisioning there. But the shale market's done. The fracking market is done. A lot of these other markets that we've seen are going to continue to be walked away from. And the diversification that I think we need to see in terms of not just portfolios, but corporations to really start matching with this has yet to come. And the supply chain impacts, like, look, outside of the president getting involved inside of meat to kind of keep that going, we've started to see the buckling of supply chains. In Maryland, they had to call 2 million chickens because the supply chain stopped. They've had to cull pigs. They've had to figure out what to do with cattle, because most of our industry is breeding these animals for mass consumption. And what's happened there? The restaurants are closed. the large scale production companies aren't producing to the level that they were, and the supply chains are continuing to buckle. And so here's my predictions in terms of this, but also the things that you need to be looking at. One is start looking at, the commodities board in Chicago and just start looking at the waves of volatility. The yardsticks that I typically use for America are soybean and pork bellies, because if you start looking at those two, because those are major produced staples, okay? The amount of pig farming in this country is massive. The amount of soybean production in this country is massive. But when you start seeing downticks inside of these things, they're indicative and emblematic of other impacts that are going to hit other supply chains. And then you also have to consider, what's going on inside of like I'm involved in the PPE market. We're rolling out a healthcare blockchain related thereto, and I've been doing some consulting, and there's conversations I think we could have with the data related thereto into Coin Genius over the next couple of weeks. But, and this has been a little bit of a shift for me because I was asked to help flying cargo over here. So a 747 cargo, which holds about 3 million masks, right? The disposable face masks, used to cost us about $350,000 a month if we were just, baking that into the cost of shipping. When you're ordering for a hospital, you're ordering for a state, you're ordering for someone else. That same plane is 1.2 to 1.4 million right now for that same leg. So, those kind of cascading costs are impacting absolutely everything else, including foreign and imported goods that are not sent here by ship. And then the last 2 points I'll close with is that there hasn't really been a full rollback of the European tariff war that started prior to all of this. And outside of medical and healthcare supplies, there's still significant tariffs on a number of Chinese goods coming in. So at the crux of this, as the supply chains continue to buckle, as there's no real key as to provenance, as there's limitations because blockchain technologies and new technologies are not able to do tracking and tracing inside of these, there's going to be continued volatility inside of the traditional markets. That's going to affect the commodities markets. The commodities markets are going to affect the traditional markets again, but those correlations may be outward and in opposite directions than what your expectations are because they're not moving in sync from a graph perspective. And then I think, as Steve Quan pointed out last week, there are interesting correlations in between the stock markets and the crypto markets, and those are things to start keeping an eye on post happening. Specifically with the smaller cryptos that anyone could get themselves involved with, and these are now problems that used to just be affecting institutional investors and large traders and wealth managers and family offices. But I'm going to tell you that within the next 20 to 30 days, the impacts are so severe that I think anyone who has a 401k or any kind of investments should start looking very carefully as to how they want to manage their money and start planning for the near future.
Well, there's definitely a lot to unpack there. The question I have for everybody is, as we see all these things unfolding, as we're looking at the commodities markets, I wholeheartedly agree with, some of the leading indicators there, especially with pork bellies and rice and different things like that. And I'm sure Steve has some things that he'd like to inject in the conversation in terms of his thoughts. But overall, I think we're all on the same page in terms of the writings on the wall. Middle America, the restaurants obviously are suffering tremendously. They can't open. They don't have the clientele to support, some of the costs associated with keeping their business open, including rent. Then you look on the other side of things, which is the luxury side. So you look at companies like Neiman Marcus, which just filed for bankruptcy, and luxury goods. There's nobody that's going to be purchasing luxury goods at this moment, nor buying luxury housing, nor looking into commercial real estate for expansion of their company. So I think the writing is on the wall 100%. And I'd just like to open it up to the entire team just to discuss how we think that's ultimately going to impact the global markets. And then ultimately, how does that trickle down to crypto?
Hey, Jeremy. And I'd like to just add something to, I guess, what I touched on last week and what Oz just mentioned, where I've gotten more phone calls and questions on how can I get involved in crude at minus 37, or hey, how do I buy it at 10 or 12 or whatever the front month is. All it is a delivery game. It's futures, guys. I used to do it. Okay, I can tell you firsthand. gold, they call it a delivery game. And there's roles. And I think I even told some people about USO and how it's really not correlated to the oil curve. And I'll just touch on one other point. WTI, also known as CL, also known as the oil, which is on many mainstream medias that is, commonly quoted. Its delivery point is Cushing, Oklahoma. I would urge those interested in buying oil at that price to look at where Cushing, Oklahoma is. I can't say this enough times. It is a landlocked area. It's the only landlocked delivery area of any crude oil contract that I know is traded. Now, as a comparison to that, Brent is what I call the world benchmark. That right now is 2420, where front month June CL is 1520. So you have to think about that. $9. Is part of this a futures algo delivery and squeeze game? Yes, unequivocally. And will things like USO get absolutely destroyed by this? Yes, unequivocally. But I just wanted to point out that RBOB or RB_F is a good proxy for the energy markets in the U.S. I agree with Oz. I myself look at wheat and gasoline, but I find it it's very interesting that others on this call aren't solely looking at, oh, wow, crude's down. I guess it's important for me to look at a basket of things where crude, yes, you can't store it. So whatever happens to that contract, it happens. Unless you have delivery in Cushing, Oklahoma, just take that off your board. It's not worth looking at. Brent, that's a delivery point all over. That's a better metric of where world crude oil markets are. And that's just my information, no opinions. Just please take a look at where Brent is. Take a look at where RBOB is. You may not know a ton about them. You may. But if they're of interest, if this commodity energy space is of interest to you, I would urge you strongly to familiarize yourself with those two futures or assets, commodities, whatever.
Yep, no, 100% agree. So let's go ahead and open it up. We'll do a roundtable. So anybody have any thoughts, comments, or questions on all of the topics just discussed?
Jeremy, this is Oz. If I could add one thing, one indicator I think that everyone needs to also add to this is housing starts and median AMI, which it'll be interesting to see where that goes inside of the census, because it's going to be a complete shift from what the expectation is. And the median AMI is going to change a lot of things. I'll give you an example. On the housing starts, I think housing, with the exception of commercial construction, a lot of things have just halted. Purchasing is continuing to go on in some markets, but in other markets it's not. And at the same point in time, what your dollar is going to go a lot further inside of 12 months. We talked about this, I think, 2 weeks ago. 2022 is where you're looking at huge defaults, but you're looking at, because we've got a mortgage, moratorium in terms of the whole defaulting process. But right now, we are going to start seeing things go into default probably within about 60 days, because we're going to be, if anyone was behind, they'll be at the 5 month, the 6 month mark inside of 60 days. And so the question then becomes one of, where does this impact the credit and capital markets from looking at landlords, including the large landlords that are out there, because places like the Cheesecake Factory and a lot of other restaurants are just telling their landlords, like, we're not paying our rent right now. And the recourse for that's very limited because half the courts are closed. And then the flip side of that is how that impacts the rental market. But I think there's a cascading question there. At what point are you actually going to see exoduses and dissonance in terms of what the rental prices are, where they actually start going down, or where landlords start adjusting those? Because I'll tell you this, with the firings coupled inside of all of this information, and you look at Silicon Valley, Los Angeles as just start points, Half of the tech workers are looking at potential furloughs or layoffs. And the question really becomes, do you have another mass exodus like you did after the dot-com implosion in 2001? And what are going to be the secondary impacts of that? And all of these things are market pressures I think we need to be keeping in mind.
No, 100% agree. I mean, and that's really the main question is what is holding up this market right now? How is the market increasing given the fact that there's so many underlying factors that lead us to believe that there's future volatility to the downside? Is it just because the average person just really doesn't understand what's going on in the background? Or is it because there's something else that's artificially inflating the market at this point?
Jeremy, I'll say one more question. It's the fact that I want to say 93.2% of trades in the futures and equity markets are black box algorithms. And for those of you that may think investing is long-term, last year, this is a 2019 metric, so I haven't really updated in 4 months, but the average holding time for a future is 3.2 seconds, and the average holding time for an equity or ETF is 5.7 seconds. So for those that think investing is long-term and it's a qualitative measure, it may be, but the 93% are trading otherwise. So they're trying to win, you're trying to win, someone's going to lose, and the markets, many are just trend followers. That's all I can say.
Yeah, that's a really interesting point. I'd be curious to know, I don't know if anybody knows this metric on the phone, what's the average hold time of crypto for Bitcoin? I know there's a lot of hodlers. It's not like there's a tremendous amount of those people necessarily in capital markets. You get those people every once in a while, those, baby boomers that might have bought Disney or Wells Fargo very early on and just held it all the way through. But overall, to your point, I mean, all of this is, bot trading, right? And I see a lot of bot trading and things happening in the crypto space more and more so. And if you look at all the order books, it's a very small fractional amount of Bitcoin that are actually being traded every single second. So obviously a lot of that is automation. How do you see that evolving? How do we see this market evolving? Is it going to be reminiscent of what we're seeing in capital markets? Are we seeing an influx of people from traditional capital markets and equities and commodities moving into this space? And do we also see the fact that crypto is being open 24 hours a day and it's a global thing impacting the way that people are trading futures markets in those markets as well? So kind of 3 open-ended questions there to whoever wants to take them.
I'll answer again if you like.
Please.
Or I'll give you my input. Over the past, I guess, 17, 18, 19, and now this year, I've seen the crypto or blockchain markets evolve from something where Bitcoin was 1,000 and it was either Bitcoin or it was a pure spec bet where there was limited info at best, and many of these small groups were dominated by, I guess, what they call pump groups. I'll let one's imagination think what those are. But as it's gotten more mature and I've seen the Bitcoin price rise to 20,000 down to 3,000 in the current, and the volume spikes, I can tell you that much of the volume is not tradable. You can infer from that what you want, but I could share information which would be very intriguing to some, and it's all screenshots and videos of various screens where markets freeze and all that. So what the true volumes are, I don't know. I can just tell you that some of the volumes are non-additive. But I do know that with crypto being open 24 hours and it being a larger portion of some funds' portfolios than it was 3 years ago, what percent, I couldn't tell you because I can't speak for every fund or family office or investment group. But people seem to be far more cognizant, where I'll always go back to March 16th. Bitcoin, crude, S&P, wheat, gold, silver, platinum, copper, palladium, soybeans, and corn all made their low for the recent move at 2:59 and 59 seconds Chicago time that day. Why? Because I can eat Bitcoin, or because I can put my corn on a private key in my locker? No, because when someone has extreme financial stress, it's I can eat or I can't eat. And if you have to sell something at a bad price, you got to do what you got to do. It's a come back another day. And the 24-hour thing, it's a blessing and a curse. Many of the liquidity providers that I talk to essentially go down to what I'll call a more skeleton crew over the New York hours weekend, which is 3:15 Eastern to 4 p.m. Eastern, Friday night to Sunday night. And you'll notice that you can see it's far easier to move something if someone wanted to with less liquidity and less providers if you have the capital base to do it. So essentially, people wake up and they see Bitcoin's at 8,000 when it closes on Friday, and then all of a sudden Monday morning it's 7,000 or 9,000 or some different price. It's simply one of the reasons is simply because some of the funds, or I guess the Chicago-based ones that I know, they don't sit in their office. They don't run their algorithms over the weekend because it's a whole different landscape. I don't know if they made some coordinated deal that, hey, look, we're not going to play on the weekend if you don't. But you'll see the liquidity. I mean, you can put out a 5 Bitcoin order for Ethereum or so. I mean, it'll sit there. And that's even on the mighty Binance. From that to other exchanges. But there's my 2 cents, Jeremy.
Interesting. Anybody else? Oz, what are your thoughts on that?
I mean, I concur in terms of the indicators that he's talking about and the directionality. I mean, like, look, a lot of folks who are looking to get into the market, whether you're investing in stocks, whether you're investing in equities, whether you're looking at bonds, whether you're looking at futures, where you're looking to buy and hold, you need to have an idea of where these indicators are and what the different, relationships are. And a lot of this stuff used to move together. Stocks and commodities used to move together. And now there's a decoupling because there's a collapse inside of the supply chains around commodities. Stocks, I mean, a lot of what we're looking at from the indices is the breadbasket of the top 30. So that's what the index is doing. So there's other things that I think we should be looking at, like what is the impact going to be of the coordinated strike on Amazon on May 1st, right? What are the impacts going to be when, we're seeing a lot of the same things we saw 100 years ago. You have labor movements correlated with, an increase in the value of these corporations that are, again, using relatively cheap labor and in many ways, but probably in ways that aren't necessarily the best, and with challenging labor conditions. But then on the flip side of this, you've got the challenge of the commodities markets and its cascading impacts, because consumption's also down, right? And that's something I don't think anyone's really looked at. While the markets are moving down for a tremendous amount of goods, including palladium and soybeans, and soybeans and pork bellies are typically the hallmark that you can benchmark how America is doing against, because 350 million people, half of the products that you have out there have those two goods inside of them. Other populations notwithstanding. But the bigger challenge here is really in trying to say, okay, well, how are you managing what your investments are, and how is that triggering or affecting what these relationships are in between the commodity sector and the supply chain behind it, in between the stock market and the fact that it's going to continue to buoy fairly well as long as those top 30 companies are doing well. But like, you look into 29 where you had just massive runs on these companies, and that's where you have a lot of the stock buybacks occurring, because people are like, well, these things shouldn't happen. I'm like, all they're doing is securitizing themselves against a run, because if they had a run of 10 or 15%, they'd see massive loss in valuation. And what that would do is that would put a huge dent in terms of what people's confidence was, and the consumer confidence index would drop even further than it has. So these are all like kind of touch points I think that you need to be thinking of in terms of the crypto correlations. I think the remainder of the panel has spoken about this relatively eloquently. Crypto is predicated upon utilization, projects, dApps, popularity, and in some cases engagement. And some of that's bot engagement, as we've seen with EOS, where there was a bunch of pumping of EOS about 18 months ago, and then again maybe 10 months ago. There are those questions around those types of projects, and I think if you're coming in, you need to start figuring out what is your own methodology for doing analysis. The same way that when a fund invests in a company, they have their own methodology for analyzing, do I think they're actually going to be able to hit their targets, and do I think that they're actually going to be able to succeed inside of whatever the market is at that point in time. But that's kind of the baselines I think a lot of folks need to start looking at. And I think hedge fund managers, family offices, institutional investors that have for a very long time made a tremendous amount of money really kind of shorting commodities and playing with stocks and in ways that were valuable to them, now have to do a lot more research, because the volatility of the market really puts us in these types of eras that honestly go back to like the Swedish Match scandal of the 1920s.
Yeah, that's all really interesting, given the fact that I think it really comes back down to, and this is kind of what you're alluding to, is people need to obviously do a significant amount of research. Otherwise, you're coming in, you're just basically utilizing emotion. You're not utilizing sound data. And for us at CoinGenius, that's what we're trying to do, is trying to garner mass adoption through the utilization of just really easy to understand metrics, so the average person can come into the space, see what's happening in real time, and make educated decisions, which leads really nicely into a conversation that I know myself and Steve want to get into about how can we as CoinGenius look at the overall landscape and create a much easier way for people to come into the space and ascertain exactly what is happening not only in the crypto space, but how can they actually quantify some of the things that they're doing around bringing and diversifying capital into crypto versus other asset classes. So I'm going to turn it over to Steve to talk about a concept that CoinGenius has pondered for quite a while and it created, and we're going to announce it for the first time here in terms of what it actually is and how we're quantifying this. But I think it's pretty exciting, and it could hopefully be a staple metric for the industry, so people have a better idea of how to quantify the space instead of necessarily just the average person coming in and trying to figure out the whole Satoshi thing, in terms of how many Satoshis equate to one Bitcoin and how does that translate and equate to $1. We're trying to create an easier metric for people to understand and use it as a baseline metric that can apply to all asset classes. So with that, Steve, I'm going to pass it over to you to kind of dive into that.
Okay, well, first, it was actually Tim Bogert, Jeremy Bourne, and Steve Quan, that's me, who were in Las Vegas for the WCC, and we were pondering an idea where, I'll say this unequivocally, Bitcoin is its own beast. I don't mean any ill will towards Bitcoin. It was the first. It has the most name brand notoriety. Like, it's its own entity. It's kind of like gold to the precious metal market. Yes, palladium is more now for the past year, but it's lesser known. It doesn't matter that the price is more. I guess if I ask many people, which I have, to name the 4 precious metals, they name gold and silver and platinum. They can't think of the 4th one, although that's the most expensive one. Now, the problem is if I said, oh yes, silver is worth 0.001223 ounces of gold, that doesn't make a ton of sense. Or if I go palladium is 1.73 gold, we don't look at it. It's not always quoted that way. But in an exchange, you could say, I'll trade you 1 ounce of gold for 120 ounces of silver, or I'll trade you 0.009 ounces of gold for 1 ounce of silver. It's an equal trade. I'll trade you $1.08 of euro currency or I'll trade you $1.08 for 1 euro currency, or I'll trade you 92 cents of euro currency for $1. Those exchange rates are traded both ways, like dollar cable, cable dollar, CAD US, US CAD. it just depends on which, I guess, side of the lens you're looking at. And for the current system, there needs to be something in the middle. So we came up with the idea of something called a stack. There's really two ways of doing it. Somebody says, what can I get for $100? Then it's just a fixed $100 bill. It's just 100. Some Tether might say, why do you need that? I would say because many don't actually have, it may not even be a cryptocurrency or a blockchain. It's just a unit of measurement. Like, what's an inch? What's a centimeter? It's not a coin. It's nothing you can go buy. It's just a unit of measure, an idea. The other, if we wanted to keep all parties really happy, is Bitcoin is not the main trading pair. Tether is not the main trading pair. USD is not the main trading pair, but you'd have something like a stack. It's $100 fixed, and it's worth 1,000,000 Satoshi. Satoshi of what? Satoshi of Satoshi. It's just a fixed $100 bill with 1,000,000 Satoshi. You can think it's worth whatever you want, but that's the fixed rate. And that way you can say Bitcoin is 88 stacks, or Bitcoin is, in any event, I'll let Jeremy expand on that more, but it's just having something at a fixed rate. Like, how much crypto can I buy for $100? Oh, with one stack, you can buy 2 Litecoins, or you can buy 0.01 bit. It's just using easier numbers. Where, what is 2 sats? Can you spend that? Is it a tangible amount? No. I look at the G20 countries, and it's not a tangible amount. Anything below really 100 sat is not a tangible amount. Where I go to the yen, which is roughly 120 per dollar. So something with 120 sat or less is not a tangible amount. And I think that's one of the important things, is just to have a stack. It could be traded. It could just be a unit of measurement. It's $100. It's what can I buy for $100? It's just a term. Or a stack is 100 or 1,000,000 Satoshi. What do I get for that? That way you keep both parties, the true crypto warriors, happy, the original, and you bring in the public where they can understand what, oh, I want to put $100 in crypto. Oh, you can get this, 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 or this. Type it into a calculator, and you're done. And Jeremy, if you want to expand.
Yeah, sure. We're going to wrap this up for a second because it looks like Kyle just joined us, and I want to get Kyle and Dustin's thoughts on the market, and especially on the mining side. But just to tie a bow in this, it really comes down to most people that I talk to, and obviously with any bull run, all your friends start asking you, your grandma starts asking you about Bitcoin. And most of them, if you lead them to just an easy to use, simple interface as an on-ramp, which is typically Coinbase, they come onto Coinbase. And because they're so used to and conditioned to understand that, a stock is a 1 share, right? So I buy 1 share of Apple, 1 share of Microsoft, et cetera. They don't realize off the bat that they can buy a smaller denomination of crypto. They look at Bitcoin and they say, well, I can't afford that. And then they move on. So in order for us to garner mass adoption, this is where this idea came out, to where Coin Genius is coining, no pun intending, the stack, right? Because it's kind of like a pancake, right? We look at it as Satoshis or the pancakes, but if you put a bunch of Satoshis on top of each other, what does it equate to? It equates to a stack. So the stack is $100. So somebody can very quickly ascertain and understand, as they're coming in Coinbase or anywhere else, that you can buy a smaller denomination of crypto. It is not like a traditional stock. And that will help tremendously. And I've explained that to several people in our network that have been asking us exactly how to get in. And for the first time ever, they understood that they could just get a stack anywhere. So if you just wanted to put a stack, $100 in any coin, now it is really easy to understand what that actually means. And they understand equally that it can be a smaller denomination, that you don't actually have to buy an entire coin. So anyway, very interesting. Love to get people's thoughts and feedback on that as we evolve this. This is the first time, like I said, we've really talked about it publicly, but hopefully this becomes something that people rely on and look to as a denomination, and as a kind of the gold standard. If you compare it to other asset classes, how is everything doing in terms of stacks? If you invested $100 in Bitcoin versus Apple versus S&P 500 versus gold, what does that actually look like? And I think that's a very interesting story. With that said, I'm going to kind of turn it over with the limited time we have left. Kyle, thank you so much for joining us. For those of you who don't know, Kyle Rea Really incredible guy in the Genius Network, active trader. I think doing really well considering the last 24 hours and what's going on. So just wanted to get your take on the market, and then we'll pass it over and wrap it up with Dustin to give us a mining update. Kyle, you're on mute, but if you want to, there you go.
Sorry, I could barely hear you on the phone. I don't know why my volume's all the way up. But as far as crypto goes right now, I know that we were at a point where it was like it could go this way or it could go this way. I'm just literally looking more at the signs of what in the economy is actually happening. Every time Fed keeps printing more dollars and, the stock market's getting fluffed up and all this other stuff, I just keep looking at the signs like what's going on. China makes their own digital currency, and then Canada does it. And then it's like one after the other. It's a ripple effect. So I'm following, the cookie crumbs, so to speak. So that's kind of how I was more biased towards a potential breakout. And then I paired that with some TA, kind of like looking at Bitcoin, and I saw like a parabola starting to form on the day chart. And every time I've ever seen that in the past, I was looking, and more or less, I always see a breakout happen. So I was like, okay, I'm going to get in position for that. Still, as Jeremy would say, anything can happen at any time. But after what we saw last night, all of a sudden the market cap goes up by like, I think 20 billion or something. Bitcoin dominance goes up by 1%. There's so much money coming in all at once, just out of the blue. It's not retail. Retail got shook out over this pandemic sell-off. So in my opinion, I think it's just like smart money coming into place. A couple of weeks ago, Fidelity was expanding their crypto trade desk, and they have like $1 trillion in assets or something. So when I see things like that, I'm looking more towards like what's going to happen, what's the long run. Pair that with the halving, which anything can happen in a pandemic, obviously, and this kind of is speculative, but at the same time, it is the future of currency. It is the next credit card, so to speak. So in my opinion, I think this is just the cusp of the breakout. And if we close, I've been watching other TA experts, and some of them have really good bias. And so what I was seeing is like, if we close above 8,200 on the monthly, it's almost certain that we're just going to keep going up. Almost certain. I always say almost because, as Steve would say, no definites. But I think, in my opinion, that big money is just trying to get their positions locked in now, because I don't think we're going to see, if there is a sell-off, it wouldn't make any sense. That slows down adoption. And if people want to make real money and get their positions in now, which it seems SEC has been cleaning up the space and everything like that, I think that what they're doing is trying to buy up their positions now before they pump to the retail, which is going to FOMO in, and that's where they make all their money, recover all their Q1 losses, set up for the next bull run, which could be, in my opinion, 2 to 3 years. If you look at it 3 steps forward, 2 steps back, the previous bull run was 20,000 Bitcoin. If we're going to use Bitcoin as an example, I know that a lot of people are pro and con biased for that, but we'll just use it as an example. I think that if we went 3 steps forward, Bitcoin could potentially go to, $40,000 to $60,000. I don't give predictions, but if that was what I was going to go with, that's what I would say. But there's a lot of real use cases out there, and I think that people are starting to look at, buying up positions in projects that they think or know can actually solve real world problems. As far as trading goes, just be careful. My strategy is get in, get out, just take small positions, constantly be closing. If you're a swing trader, if you're a holder, just dollar cost average in. Not investment advice or anything, but that's kind of how I'm looking at it. Hopefully that helps you guys.
No, absolutely. Thank you, Kyle. That's great. No, so
Kyle
the one thing
can I ask?
What's
Kyle
up?
Ray, I want you to emphasize the chart that you said on a what basis? Monthly? And I'd like to emphasize.
If we close at 8,200 on the monthly, what some TA I saw from an analyst that I really enjoy. His name's Crypto Tyler on YouTube. He's up there every single day, and he's a really smart guy. So I saw his video, and that made sense. I know Jeremy said something maybe about a $9,000 close, and I agree with that too. I think that if you look at the descending wedge on a weekly chart, if you put it at the top of the wick all the way down, matching all the wicks going all the way down, it would be about a $9,000 close for me to say, yeah, I think we're probably going bullish. So we're still in that little gray zone, I think, right there. But if we close on the monthly, I don't think that, I mean, once you get momentum going up, it's really hard to slow it down unless some whale, like I said, pulls the rug out. But if you're seeing this much money come in all at once, that would be stupid for anybody to sell a big position other than to maybe collapse some, over leveraged longs or something like that.
And the first 5 days and the last 5 days of the month, Steve has said for a while, continue to be important. Dustin Minch in the house.
Yes, sir.
Mining
Yes,
expert.
sir. Yes, sir. Dustin Minch, the mining expert. On the mining side, I've kind of, when it comes to Bitcoin mining, of course, I've kind of closed my eyes because, it's kind of a big man's game. But on the altcoin side of mining, it does look like the profits are starting to creep back up. I haven't looked at the price of Ethereum in about 3 weeks, but just looking at the profits, looking at the mining calculators, I can instantly see that the price of Ethereum, just based on the 24-hour profits going up, that usually tells me the price of Ethereum is going to go up or is going up right now. What's really kind of got my interest is there's a coin that I mentioned a while back that you could mine on like a laptops. It's like a low budget mineable coin called PegNet, and it runs on the Factom blockchain, and they just partnered with Chainlink. And so it's kind of a different form of mining. It's not your traditional proof of work where you're verifying transactions. Instead, these miners act as oracles to pull in APIs and agree on the price of these synthetic assets. And so I did post a link about this in the Discord, but PegNet, essentially what it is, it's the first proof of work stable coin. And you can, obviously, like I said, you can mine it with a CPU, a laptop, and inside of the wallet, the PegNet wallet, there's over 30 different synthetic assets. So say you mined 1,000 PegNet and Steve Quan says, hey, the price of gold's about to go up. You can essentially take that PegNet and lock it into the price of gold, ride that wave up and sell it. And you don't need an exchange to do this. It's all within the wallet itself, which makes it really unique. But it's not only pegged to gold, it's pegged to silver, 14 major fiat currencies, and 14 major cryptocurrencies. So you can take your PegNet, trade it into Bitcoin if you want, ride that up, and sell it, and then accumulate more PegNet. So it's kind of interesting to see that these miners are not only going to be verifying APIs through the exchanges, but they're also going to be verifying through these APIs from Chainlink as well, so they can get better average prices from multiple different sources. So there's a link there's an article that I shared in the Discord if you guys want to check that out. And I do have a YouTube video that shows you how to get set up and get mining PegNet with like your just any regular at-home computer. So that's really all I got on the mining side of things. So thanks.
That's great.
Yeah.
Once again, Dustin Minch coming through. The last few times that you've told us to look at things, it's been a really great tip. Handshake was one of those. I know you mentioned Aeon very early on, so this is just yet another one. So thank you for that. Really appreciate it. The last question that I really have for everybody, and I wanted to open it up, and especially since Kyle's here, I think this would be interesting. So we at Coin Genius look at obviously correlations and regimes. So whatever the market regime is, how does that actually impact the price? As we saw very early on with extreme fear tended to couple and have a tight correlation with all asset classes. So equities go down, crypto goes down, gold goes down, etc. And then we saw some sort of slight decoupling. Now what I'm seeing personally and what we're verifying internally with some of the metrics is that there's another market regime shift back towards what I saw before, which is anytime the equities market moves, it seems in a positive direction and creates that validation, then the crypto markets are now following. And I think they're moving in concert with one another. Once again, that is worrisome to me in the sense that everything that we talked about with Oz earlier about all the economic indicators that are showing, potential downward volatility. And, once, you look behind the curtain and people realize how bad certain things are and how disrupted things like supply chains are, it's going to have a negative impact, obviously, on capital markets. So with that said, what do people think? And what are your guys' viewpoints in terms of this current regime? Do you tend to agree? And if we had 1,000-point downturn tomorrow, do we think that will actually impact the crypto markets in Bitcoin? Or do we think that it's running autonomously on its own? There's so much momentum that it can't really kind of be disrupted at this point.
A stock market crash, Bitcoin will go down. I can say that. You got to think, just like Kyle said, who's buying? It's institutions. The price isn't going up by people selling. It's going up by people buying. So if things are up and there's stress on a market, then things get sold. To what extent? I don't know. Bitcoin down $1 or 1,000, I couldn't tell you that. But Bitcoin holders, you don't want a stock market crash. Like, that's bad. You gold holders, you don't want a stock market crash. I've seen it in 2008. I've seen it this year. I've seen it in 2011. An extreme financial stress event, generally speaking, just think, if you need to eat or sell Bitcoin at 5,000, what are you going to do? Because if you don't eat, you die. So those are, I guess, when the proverbial thing hits the fan, if you have to sell something at a bad price to come back to play another day, that's what you have to do. Because if you don't, you can't play tomorrow. What did it matter?
I agree with Steve there. Yeah, food and health always comes first. Always, always, always. I'm seeing that food supply chains are starting to get locked down. A lot of truckers are getting COVID. A lot of workers for the farms are not coming into work. That means there's no one to maintain the vegetables, fruits, and I heard like chicken farms, they were just straight up going to kill a bunch of the chickens, and not even because there's no restaurants open, stuff like that. We're just at the beginning of this thing still, I think, unless, like, I don't know when we're coming out of lockdown. Like, they might try to ease us back into it, but overall, there's still not a cure. So we still got to take that into consideration. The second thing is people are all at home on their computers. What are we going to be doing? That's probably another reason the stock market or crypto is going up, because we are paying attention to this information, and there is a lot of people doing education, and we got to figure out ways to make money. So how are we going to do it? I know, again, that a whale or someone like that could just pull the rug out, but as a bunch of institution brings money into the space, it becomes harder to manipulate the space because the market cap goes up. Whereas we were sitting at 150 or 200 billion dollars market cap in crypto, one person pulls out 10 billion, it collapses a bunch of longs or whatever, switches sentiment, wrecks a couple retailers, and you just go back and forth and back and forth, and then they're just washing out, weak hands. But now when you see so much extra money and capital coming into the space, it kind of switches sentiment in a way to where if someone pulls out 10 billion, they're probably going to FOMO in, because what if the market does keep going up? We don't know how people are playing it, but at the same time, credit cards was the last evolution of money. Now there's a big talk of like germs on dollar bills and stuff like that, how much it costs to print it, tracking all of that, ease of use, because we're all behind our computers now. So how do we get our money out when the banks are closed and I can't even physically go into my bank? I'm going to send you some crypto and you're going to get it in a couple of minutes, probably, or less, more or less, depending on what crypto you send. So I'm thinking more adoption phase, like how is this actually helping? And we're going to start seeing more and more people realize the use case is pretty strong. There might still be like security issues and like onboarding issues for general population, but as more people are at home creating educational tutorials, like the Coin Genius Network and stuff like that, it's just going to help, in my opinion. So, I mean, that is a completely different sentiment. I'm just looking at it in a completely different way. So I guess that's my perspective there.
I concur with where you're going with this. This has just started. We've talked about this again, over the course of weeks. Right now, there's roughly $4 to $6 trillion worth of injection that's been made into the markets just to continue to prop things up. The Treasury's lending, and the Fed will lend banks up to, I believe it's $1 trillion a day, just to kind of keep things stabilized. And then the banks are making a tremendous amount of money on these PPP loans that are coming out. I know I called my banker on Sunday and she answered, which I didn't expect. I expected to leave a message. But the challenge I think we're going to have is, again, the decoupling of expectations from what the norm is for consumers and for investors globally. As the supply chains ripple, we're going to continue to see just different aspects of those, and the different companies connected to those segments of the supply chain have those cascading ripples themselves. And then secondarily from there, we're going to run into market challenges where people are basically trying to start running away from the existing markets and try and put their goods into something else. Cash for right now is king because the dollar is still holding, but hard assets, gold, silver, these types of things, the demand is through the roof and people are paying premiums on them. Crypto is about the only sort of logical best bet, but there's a lot of custody questions. And I'll tell you what could happen inside the next 2 months. As family offices realize that they're taking massive, massive hits, and as funds realize they're taking massive, massive hits, what they may start looking to do is to diversify into crypto with trading, very much like our friend Kyle Rea does. But they need custody solutions. And, they can't have one trader having access to the entire portfolio because you end up with situations like Hin Leong, where, the son of the company traded futures, lost $800 million and cascading impact of $4.3 billion to a bunch of banks. Those types of things are starting, and that's parallel to the market indicators that we're seeing right now. But get ready for a rocky ride and a roller coaster ride over the next couple of months, because as these different segments continue to decouple, we're going to kind of see a lot of impacts that I think a lot of people were not prepared for.
Yeah, I would tend to agree. I think it's going to be an interesting ride. Once again, just kind of final thought. I think a lot is being propped up with hot air. I think it's just a matter of time, based on some of the metrics we discussed earlier, to where the equities markets and even some of the commodities, we just see kind of a downward spiral. I don't know yet if that's going to impact crypto. However, things like what Steve just said, when you're losing a tremendous amount of wealth and you have to decide between, eating food or buying healthcare or whatever it is versus buying Bitcoin, what are you going to do? You're always going to default to taking care of yourself and your personal health. So it's going to be interesting to see how this goes. We're going to keep our eyes on the market. If anybody ever has any questions, please feel free to reach out to us. And once again, thank you for everyone to joining us on Genius Wednesday, and we'll look forward to talking to you guys next week. Have a good one.